everybody, self-employment tax. So self-employment tax, if you recall, there are two different types of tax here. We've got Social Security, which is part of it, and we've got Medicare, right? And we've got, when we talk about employer-employee, the employer and the employee share these taxes, right? They split them equally. When you're self-employed, you are both employer and employee, and so you get the privilege of paying both halves. So 12.4% here, 2.9% here, for a total of 15.3%. Now, if you recall, Social Security has a wage base, which in 2023, I think that's what this book is using, was $160,200. Medicare has no wage base, so it goes up to infinity. Social Security tax at 12.4% is only applied on the first $160,200. That is combined all wages and all net income from self-employment for the individual for the year. So if an individual has multiple jobs, you'd have to total up all of it, and it shouldn't exceed $160,200 would be the max that is subject to that Social Security tax. Any overpayments are refunded on the tax return, on the 1040. All that stuff is calculated in. If you, like in your software, you notice when you enter in the information on those W-2s, there's space to enter in, and you should be entering in the Social Security information, Medicare information, and all of that stuff. All that goes into the calculations. The software will determine whether or not there's been an overpayment or an underpayment of any of those taxes. Okay. And then we've got the additional Medicare tax. Remember that? So that's 0.9%. That's applied to self-employed individuals as well, but this is on, well, I'm going to wait a minute to tell you what the income amount is, because in payroll we learned that it was employers start withholding once income reaches 200,000. But it is the actual amount of tax is dependent on, the tax base for that is actually dependent on filing status. So employers will withhold starting at $200,000, but they don't know what your filing status is, right? They don't know how you're filing your tax return, so that's just kind of a standard for them. Again, that's another item, another tax that gets reconciled on the 1040. So if you have, I don't know, any situation where you would have overpaid additional Medicare tax. If you've actually there is. If you've overpaid additional Medicare tax, then it'll get reconciled. You get a refund for that amount on your tax return. If you've underpaid, then you'll owe an additional amount, an additional Medicare tax. For our purposes in this class, though, we need to go into a little bit more detail about how the self-employment tax works. Okay, in payroll accounting, it was pretty simple. It was just, it's these tax rates, and it's applied on, you have $100,000 of income, 15.3%, so you're paying $15,300. Actually, a little bit more complicated than that when we get to the income tax form. Okay, so first off, I shouldn't say the first 400. If your self-employment income, net self-employment income, is under $400, you don't have to pay self-employment tax on it. So if it's under $400, you don't have to worry about paying any, and that's net. Like you could have $100,000 of gross income, and then $99,700 of expenses. Your net is under $400. You don't have to pay self-employment tax on it. So that's the first thing, which is a little bit different from, we didn't really get into that when we were in payroll accounting. Also, just as a reminder, we do talk about this in payroll accounting, but you probably forgot. partners and partnerships are considered self-employed. Okay, a partnership, these are just the partners. Like partnerships can have employees, but employees in a partnership are not partners. Partners are the owners of the partnership. If they provide services to that partnership, meaning they're not just passive investors in the partnership, but they're actually actively participating in it, then their income from that partnership, their portion of the income from that partnership is considered self-employment income. Essentially, a partnership is just a sole proprietorship with more than one person. So all the rules that apply to self-employed individuals also apply to partnerships, but it just gets a little weird because you got more than one person. So anyway, so that's what a partner and a partnership as well. 160,200. So the first 160,200 of income is subject to Social Security tax, 12.4%. All of the net income from self-employment is subject to Medicare tax, 2.9%. And then we've got this additional Medicare tax of 0.9%. You can see here, if you are married filing jointly, that additional Medicare tax doesn't start to kick in until $250,000 of income. Now, it's still based on individuals, but if you're married filing jointly and your joint return is, let's see, yeah, if you file a joint return and your self-employment income is over 250, not 200,000, that's when it kicks in. Okay. So, trying to think, if you're an employee, no, I'm sorry, I said that wrong. It's 250,000 in total. Your total income for the return is over 250,000, then you are subject to that additional Medicare tax. For married filing separately, it's 125,000. For everybody else, it's 200,000. So when you're looking at it from the employer standpoint, you're just assuming that everybody's in this category, and that's what you're going to use, the 200,000. Also, the wages apply to those thresholds as well. Okay, so that's kind of the difference with the additional Medicare tax. The next thing that we have to do that we did not discuss in payroll accounting is, in order to actually calculate the self-employment tax, we don't take 100% of the net income. We take a percentage of the net income. We take 92.35% of the net income. So if we've gone through, let's say we've got gross income. This is our Schedule C. Here. Our gross income was 250,000. Our deductible expenses were 150,000. So our net income is 100. We do not calculate this based on this. First thing we do is we take 92.35% of that. So $9,235, $92,350, sorry, is what we use to calculate our tax. So the first thing we're going to do is reduce this amount by that. What is this? Well, if you take 100% and you subtract 92.35%, you end up with 7.65%. That's the amount that the employer would have gotten a deduction for, right? So we're going to take that amount out here before we calculate what the self-employment tax is, if you have an employee-employer relationship there. All right, so this is actually the amount that is our wage base for calculation of self-employment tax. Okay, let's look at what example they have here. So Linda's employed at a local bank. She has wages of $168,000. She also has a Schedule C business selling jewelry at night and the weekends. She has net income from Schedule C of $15,000. Linda owes 0 additional Social Security tax because her wages were already over that wage base, right? She made $168,000. She reached that $160,000 with her day job. So when she's calculating her self-employment tax, she doesn't have to include the Social Security part. So all she's gonna do is take the $15,000, multiply that by 92.35%, and then multiply that result by the 2.9% for Medicare tax. So she owes $402 in Medicare tax. Okay. Suppose her wages from the bank were only $79,200. Okay, well now she is under that $160,200 wage base. So all of that $15,000 now would be subject to Social Security tax, because that doesn't get her over the wage base either, right? Again, we're going to multiply that by the 0.9235. This is going to be multiplied by the 12.4%. This, again, same calculation there. Add those two together. Now she owes $2,120 of self-employment tax. So this is the amount. Remember, we had that deduction on the schedule from the Schedule 1. That adjustment for 1/2 of self-employment tax is based on this. There's a separate form called the Schedule SE where all of this is calculated. So again, if you're having problems with the calculation, you can use that Schedule SE and go through it line by line. Go through it line by line and it will help you with the calculation for it, right? And here it is. So here's the Schedule SE. Let's see. Net profit. So what we're doing here, the Schedule C, so this is for farms. We're not going to use that. Net profit or loss from Schedule C, line 31. So that's going to be after we've calculated our home office deduction, if we were entitled to it. That result is going to go there. And then it shows you right here, if line 3 is more than 0, multiply line 3 by 92.35%, right there. So there's the reduction there. If line 3, if line 4A is less than 400, oh wait, that's not the 400 that I want. That's the CRP. Never mind, don't do 4B. Line 4C. Combine lines 4A and 4B. If less than 400, stop. You don't owe any self-employment tax. Unless it was church employee income. Don't worry about that. So, so it says right there, that $400 limit. Stop. You don't owe any. You don't have to do this. Multiply, what is this? Oh, church employee income, don't worry about that one. Line 6, add lines 4C and 5B. There's nothing in 5B, so there. And then here is the maximum amount of combined wages and self-employment earnings subject to Social Security tax. There's that $160,200 right there. Total Social Security wages and tips. So this is the calculation of, you would then transfer anything from the W-2s here, because what this is doing is it's including that in the total calculation. Did you get above this $160,200? Okay. Unreported tips, all that stuff. So total there. So the $79,200, this was her wages, remember, and then she had $15,000 from self-employment. Subtract line 8D from line 7. So we're subtracting this from this, whoops. Her wages from the wage base, the Social Security wage base, to determine how much is left. How much more does she need to earn before she gets to that wage base? Multiply the smaller of line 6 or line 9. So she didn't get to the wage base, and this line is calculating that. It's saying multiply whichever is less of those two by the tax rate, by the 12.4%, and then multiply line 6 by 2.9%, add those two together. Self-employment tax is here, and then it tells you where to enter it. Schedule 2, line 4. And then line 13, you gotta do this part, deduction for 1/2 of self-employment tax, multiply by 50%, enter here, and on schedule 1, line 15, which is where that deduction for 1/2 of self-employment tax would go. And this is where it's all calculated. All right. Questions about that? Let's see, is there anything else here? Stop. So this is a comprehensive. I'm gonna go through that. This is still part of the same thing. All right. Oh, QBI. One more deduction. Remember I said, so on the 1040, we've got the space for the standard deduction or itemized deductions, and then there's another deduction in there called the qualified business income deduction. Okay. You do have part of your tax return problem as you calculate this. So. This again is a new thing that was implemented with the tax law in 2017. What they did with the tax law in 2017, they reduced the corporate tax rates from 35% to 21% and just made it a flat rate. The corporate tax rates used to be progressive, like the individual tax rates are, but then they changed it to just a flat tax rate of 21%. Highest tax rate for corporations was 35%, lowest was 15%, so some corporations actually got a tax increase with this move. They did this, and then they were just gonna let it be, and then people started screaming about, well, wait a minute, legitimate complaining. Most businesses in this country are not corporations, are not C Corps. They are sole proprietorships, they are S corporations, they are partnerships, they're smaller businesses, and you're not giving them this same tax benefit. So they went back to the drawing board and said, okay, well, what we're gonna do is we're gonna implement this qualified business income deduction. It's also called the Section 199A deduction. And essentially, and this is for individuals, so if you have a Schedule C business, if you're active in a partnership, rental properties as well, if you are actively engaged in them, not just passive, flow-through businesses, so LLCs, S corporations, even trusts and estates, if you're active in it, will get this 20% deduction. And this was designed to make it more equitable between those small businesses and the large corporations that got this tax cut. So this is called the qualified business income deduction. So it is after AGI, and it's after the standard itemized deduction. So you see it shows up, the actual deduction itself shows up on the first page of the 1040, the calculation that was done elsewhere. All right. So calculated by, and you calculate it by multiplying line 31, which is the net income on Schedule C, minus, and this is important, minus the deductible part of self-employment tax, that 50%, so if you've got, we did our calculation, so say our net income was 100,000, which means our self-employment tax, so this would be line 31. And then when we do our self-employment tax calculation, we're gonna take that 100,000 times 92.35%, so 92,350, and we're gonna calculate, so this times 15.3%, this is our self-employment tax, which comes to 92,350 minus 153, 14,129.55, so we're gonna round that to 14,130. This is our self-employment tax, and then we'll take 50% of that for that deduction. So 7,065. So 1/2 of that. So what we do, multiply line 31 less the self-employment tax, less deductible health insurance. So if we had some self-employed health insurance, we would also deduct that. So line 31 here, then we're gonna subtract 7,065. We don't have any self-employed health insurance, but if we did, we would subtract that as well. 100 minus 92,935. And then we're going to multiply that by 20%. $18,587 is our QBI. Well, it's the lesser of 20% of, this is our QBI right here. Our qualified business income. This is our QBID, qualified business income deduction. All right, so the deduction is the lesser of 20% of QBI or 20% of taxable income less net capital gain. So you have to do a calculation on that as well. Whatever your taxable income is minus any capital gains. So and then you take 20% of that as well. Whichever is lesser of those two. So if this was the only income, we didn't have any capital gains or anything, then this would be our answer. 18,587 would be the deduction that we get. So we get our standard deduction, and then this would be underneath it. Your problem has you do this, and be careful. Because it's really easy to say, oh, well, it's just 20% of $100,000, it's $20,000. It's not $20,000. You have to make some adjustments to it first, okay? So make sure you kind of highlight that in your book for that calculation. So the QBI deduction does have some other limitations. If the business income is from a specified business that includes service fields, health, law, accounting, consulting, athletics, brokerage services, or where the business income is generated from the reputation or skill of one or more employees, the deduction is limited. So, other types of businesses, there's no income limit to this. If you have $1 million of QBI, then your QBID is $200,000. However, if you're an accountant, it's different. So the deduction is limited when taxable income on the entire return is greater than $364,200, depending upon filing status again. I'm not going to go through all of those. It phases out over $100,000 range for married filing jointly, or $50,000 for all other taxpayers. You do not have any problems that deal with this, by the way. This is just kind of an FYI that there are further limits to it if you're in certain professions. I don't know why they're hating on the accountants. They're always hating on the accountants, but, and the lawyers. I can understand why they're hating on the lawyers, but the accountants haven't gotten into too much trouble recently that we know of.
Is that your cousin
Right,
a
they have-
lawyer?
Yeah. All right, let's see what else. There is an additional W-2 wage limitation, in which case, so if the taxpayers are above that threshold income limit, but they're not in the service fields mentioned above, so if you're above that limit and you are in one of these professions, it starts to phase out until it's 0, and that's it. If you're over that income amount and you're not in one of those service fields, there's still an additional limitation. It's gonna be the lesser of these two. 20% of the QBI, or whichever is greater, 50% of the W-2 wages with respect to the business. So if the business paid W-2 wages of $100,000, 50% of those wages would be included in there. Or the sum of 25% of W-2 wages plus 2.5%. It's just, I don't know who thought this up, but, again, you don't have a calculation involving this. You do have a calculation involving this, okay? So, that's the part I want you to really focus on. I'm gonna go through them. So Allison makes $200,000 in QBI from her Schedule C net of her self-employment tax. Taxable income on her Form 1040 is $180,000. Okay, so this is an example, like you're comparing it between that other. Less any capital gains, $180,000. Taxable income could definitely be less due to 4 AGI deductions for self-employment tax, self-employed health insurance, and itemized deductions. In this case, so you take 20% of 200,000, which is $40,000, compare it to 20% of 180,000, and you're gonna take the lesser of the two, which ends up being the 36,000. Here's Allison. She makes 500,000 QBI from her Schedule C. She's in a law practice. Taxable income is 620,000. She gets 0 because her law practice is a specified business. And here's an example of how the W-2 calculation goes. I'm not gonna go through all that though. Questions? Okay.